Look closely at the screen of your broker application today. You see Nvidia scaling heights no corporation in human history has ever touched. You see Microsoft, Google, and Amazon printing press releases about the dawn of an autonomous future. Inevitable, doesn't it? A straight, unbroken line toward total digital dominance. But tonight, we are going to look where they don't want you to look. We are stepping out of the clean, air-conditioned corporate boardrooms and walking straight into the physical world, where the digital illusion meets cold, harsh reality. Right now, beneath the surface of the tech sector, a silent panic is unfolding. More than 50% of all planned artificial intelligence data center projects globally are being quietly delayed, frozen, or canceled entirely. In the United States alone, half of the multi-billion-dollar infrastructure pipelines scheduled for 2026 are suddenly paralyzed. A few weeks ago, a flash notification hit the Bloomberg terminal, heavily obscured by corporate PR talk. Oracle and OpenAI have officially abandoned their flagship data center expansion site in Texas. This wasn't just a minor operational hiccup. First major fracture in the foundation of the artificial intelligence boom. My name is Professor Alpha. In my 47 years on this planet, half of which were spent analyzing institutional capital allocation, I have learned one fundamental law. Software is infinite, but reality is finite. Tonight, I am going to show you exactly how the tech titans built a digital empire without checking if the world actually had enough electricity to power it. Welcome to the AI Blackout. To understand how we arrived at this cliff, we have to look at the sheer scale of the madness. Ever since ChatGPT was unleashed upon the public in late 2022, Silicon Valley entered what can only be described as a modern-day gold rush. But they weren't buying land. They were buying compute. By 2023, global capital expenditure on AI infrastructure cleared $200 billion. By 2024, that figure doubled. By 2025, the combined capital expenditure of just 4 companies, Microsoft, Google, Amazon, and Meta, reached an astronomical $400 billion. To put that into perspective for you, in 2025, for the first time in history, the amount of money poured into building data centers surpassed the entire amount of capital spent on single-family home construction across the entire United States. Think about that. We spent more money building concrete homes for microchips than shelter for human beings. Amazon announced a $20 billion campus. Google committed $40 billion. In Pennsylvania, a single tech giant quietly mapped out a staggering $50 billion infrastructure layout. But then, the machines hit a wall. And that wall is called the electric grid. Data centers are not clean, ethereal clouds. They are industrial factories that consume massive, unprecedented amounts of electricity. Currently, AI data centers consume roughly 2% of the entire global electricity supply. But as these hyperscale facilities started turning on their servers, the regional power grids across America began to buckle. In winter, parts of the American Midwest and South faced unprecedented voltage drops. Local utility companies delivered a brutal ultimatum to tech executives. If we keep your servers running this winter, millions of American homes will lose their power. The digital dream was suddenly threatening to freeze real people in their living rooms. Tech companies promised these centers would run on clean, renewable energy, but that was marketing. The cold reality is that over 60% of the power keeping these AI chips alive comes from traditional fossil fuels. And this is where the macroeconomic trap snaps shut. You cannot separate Silicon Valley from global geopolitics. As the tech giants demanded more power from fossil fuel grids, the geopolitical landscape fractured. The escalation of conflict in the Middle East, particularly the escalating maritime and trade disruptions involving Iran, sent shockwaves through the global energy matrix. Crude oil and natural gas prices didn't just rise, they became wildly volatile. If you live in Pennsylvania or California, you felt this at the pump, with a gallon of regular gasoline spiking past $4.58 in a matter of days. But for a data center, this volatility is lethal. When energy costs rise by even 10%, the operational cost of running a 100,000 GPU data center skyrockets by millions of dollars per week. Tech companies calculated their profit margins based on cheap, abundant electricity. Now, with the shadow of regional wars looming over global supply chains, the electricity bills for these data centers are spinning completely out of control. They realized they were playing a losing game. You can build the most intelligent neural network in the world, but if the local power plant cannot supply the gigawatts required to wake it up, that neural network is nothing but an expensive collection of dead silicone. This is precisely why Oracle and Sam Altman's OpenAI had to look at their Texas expansion project and quietly pull the plug. The infrastructure simply isn't there, the power isn't coming, and the costs are no longer justifiable. Now let us turn our attention to the eye of the storm, Nvidia. For the first 30 years of its existence, Nvidia was a household name only if you had a teenager playing video games in your basement. Today, it is a multi-trillion-dollar titan, briefly surpassing Microsoft as the most valuable corporate entity on Earth, with its stock surging over 170% in a single cycle. Its CEO, Jensen Huang, became the high priest of the new economy. Jensen Huang stood on stages next to Sam Altman and Greg Brockman, declaring that Nvidia would ship massive amounts of its high-end Blackwell and H100 architectures. They announced grand circular agreements where Nvidia would invest billions back into AI startups, who would in turn use that money to buy and sell more Nvidia chips. Look closely at the mechanics here. Independent financial analysts and risk managers are now raising a terrifying red flag. Nvidia's demand projections are massively artificially overstated. Goldman Sachs published a highly restricted analysis showing that the actual operational capacity of functioning data centers worldwide stands at roughly 7.7 gigawatts. Do the math. The number of chips Nvidia claims to have sold and deployed requires nearly 3 times that amount of physical capacity to even turn on. So, where are all these chips going? Tech giants like Google, Meta, and Oracle fell into a classic prisoner's dilemma. Terrified of falling behind in the AI race, they panic bought every single GPU they could get their hands on. They hoarded silicon like people hoarded toilet paper in 2020. They assumed that infrastructure capacity would grow to meet their demand. They were wrong. Today, Nvidia's inventory levels are rising at an alarming rate. The supply chain has shifted from extreme scarcity to an ominous oversupply. Tech companies are sitting on warehouses full of $500,000 chip arrays that they cannot plug in because the local electricity grid cannot support them. Nvidia printed record-breaking profits last year. Yes, but those profits were borrowed from the future. It was a massive, unrepeatable wave of panic buying. If this story sounds familiar to you, it's because you've seen this script before. Just a few years ago, the exact same boardrooms told you that the Metaverse was the future of human civilization. Billions of dollars were reallocated, stock prices pumped, and retail investors rushed in to buy the top. Today, the Metaverse is a ghost town of abandoned code and written off billions. The AI infrastructure boom is running on the exact same psychological mechanics, but on a scale 10 times larger. Tech giants are projecting future cash flows from AI products that do not yet exist to justify capital expenditures that the physical Earth cannot support. Let's look at the cold, hard reality. The heat map of global data infrastructure shows that in the last quarter alone, over 25 major hyperscale facility contracts were completely ripped up. Nearly 100 planned sites are currently under administrative review or structural freeze. What does this mean for you, the retail investor? It means that the disconnect between the stock market charts and physical reality has reached its absolute peak. If tech giants start writing off $20 billion data center cancellations, the massive revenue streams projected for the entire semiconductor and tech sector will evaporate. The downward revaluation will not be smooth. It will be violent. As a professor of finance, I am not telling you to panic. I am telling you to open your eyes. Stop trading the hype on your phone screen and look at the physical constraints of the world. Watch the energy sectors, Watch the grid developments and pay very close attention to corporate capital expenditure revisions over the next 2 quarters. The digital world thought it could outrun the physical world. It was wrong. My name is Professor Alpha. Subscribe, stay rational, and protect your capital. I will see you in the next analysis.